Guys, it's Markets with May, and in this episode, we are going to be talking about JP Morgan taking over First Republic Bank, the deal terms, and the implications. And full disclosures first, and then we'll jump into it. Past performance not indicative of future returns. I have actually a bunch of calendar spreads and diagonals on First Republic, so I'm going to go ahead and disclose that. And as some of you guys as some of you guys that follow me on Twitter know, I did the calendar spreads because the math didn't make any sense given what was happening. And we shall see what actually happens when First Republic clears. So first, let's talk about First Republic, because I know that some of the people that are watching me were probably watching some of my posts that I was doing on Twitter as relates to option strategy on First Republic. First Republic is a halted. Does it need to become unhalted? Actually, no, it does not. So just realize that. When I go back through the annals of my memory banks, because this is really being done differently than any other bank takeover that I've seen. And there may be people that argue because they've either lived longer or were paying more attention in 2008 than I was. My stuff has always been large cap, so possibly there's another thing. But here's my version of truth in all of the different decades that I've looked at issues in large cap land. Okay, usually it looks more like Credit Suisse. And if I did actually post in the show notes the UBS Credit Suisse takeover, if you will. Here, they're using very particular language where they're talking about JP Morgan taking over the assets. And they were very clear that the preferred shareholders are getting hung. They didn't really discuss what's going on to the actual common stock shareholders. So that's kind of an unknown given the way it was verbalized. Very carefully, I double checked this, but if someone saw something, then put it in the comments as well, because I think everybody across the street is still absorbing it. So that's the first thing. Usually it looks more like Credit Suisse. Now, if a bank truly goes defunct because of credit losses, historically, then it doesn't necessarily need to trade again. Usually I see that more on the broker dealers. For example, one time a long time ago, I took a flyer on this company called, I think it was called MF Global, something like that. It was a broker dealer, and they had mad commodities exposure, and the spreads blew out and just took them collapsed the entire financial organization. And that one never started trading again. So that can happen as well. But here we don't have credit losses. And also we don't have a stated deal price. We just have the sale of assets. And so you really almost have to go through and see if there's anything left. And since there's nothing that's toxic, it gets not straightforward to do that, which is why the stock should be, and rightfully so, halted. Why, number two, I think this deal is a little strange and different and difficult for the powers that be to digest. And three, it becomes then impossible to know how to think about your options position one way or the other. However, like I said in my tweets, the calendar spreads being madly mispriced because you should not be able to do them for more than what have you. In fact, if you tried to enter in a calendar spread at a credit the way that I suggested it in my tweets, you actually, the broker would reject the trade. So just realize that I think all of this is big placeholder, and it is also possible that the stock never opens. But let's see. Okay, so now let me go through the slides that I have prepared. Here were the acquisition details. Let me see if I can increase this at all. Hopefully you guys can see this. And I know that a lot of folks have gone through this, but I'm going to go through this ever so slightly differently, because I think when people go through it, they just literally say the words and they don't think, hey, what's that mean? But you can kind of go through it. Here, let me move this up so my face isn't on top of some of those. The key thing here, $173 billion worth of loans and $30 billion worth of securities. I'm going to do in the very next slide exactly how that maps to the balance sheet of First Republic as reported on the last quarter, which would have been March 31st closing. And then This right here is probably the most important piece. They're paying the FDIC 10.6 billion, which gives you a sense that they also don't believe that there's a problem with this balance sheet, because remember, it's like $100 billion worth of deposits, 25 billion of which they're paying back to everybody else. 5 billion was JP Morgan's deposits. So really, let's call it $70 billion worth of deposits minus whatever left the bank from the earnings report. And where we are now, and they're just giving the FDIC 10 billion. And this speaks to what I kept saying, which is if someone purchases them and can stabilize the deposits, then there's no need to freak out. So it's really been about finding a buyer that could stabilize the deposits. JP Morgan technically shouldn't have been allowed to buy this because we're trying to keep banks at less than 10% of all total deposits. But nevertheless, here we are. And I spoke to that too, by the way, both on my Twitter and in my past, which I said it was going to take it was going to take a relaxation of the rules for JP Morgan to do it. Now, the other thing that's kind of going missing here is this one right here. This is actually very important. FDIC will provide a $50 billion 5-year fixed rate term financing. What's the terms of the financing? No one told us. That's why JP Morgan actually absolutely 100% should trade up. And also this deal is being done. Okay, let me actually hit the pause on the presentation and then say this in one fell swoop so you can understand it. JP Morgan bought this and it was a good deal. And I almost wonder if the reason they don't do these live casts via video is because then Jaimie Dimon doesn't have to keep a straight face when he talks about how amazing this deal is. Because again, like we have talked about, there's no credit losses and he's getting crazy good terms on financing from both the FDIC. So like, let's go through this just so you can see how and the thing that makes it really insane is that it's at the expense of whoever owns the shares of First Republic first and foremost, and then the entire banking system secondarily. Just, and I'm not saying that to be mean to JP Morgan, it's just that's what it kind of looks like when I go through all the pieces of this. Okay, back to sharing. So this right here is a little bit awkward. Now let's go through what it is JP Morgan actually bought, not the short form that they gave us. Okay, this was the balance sheet of First Republic on the on the March quarter, $172 billion. So in the green box is what First Republic had. In the blue box is what JP Morgan said they bought as far as the assets go. In the red box is what's kind of unaccounted for, realizing that First Republic was probably selling down assets and also deposits were changing. So it was a moving target. So that moving target piece is what's in the red box. Okay. So let's just go through it. This whole mess of loans, they bought 172 billion. So more or less all of those loans, plus the 34.7 held to maturity loans, 29.6 billion. Some of that, since there's not a securities line item here separated from the loans, some of that could have been the held to maturity assets. There's 5 billion in other that they took in, which I suspect, since of the way that it maps, is the life insurance plus the tax credits. So mostly they took in everything but about $30 billion worth of loans. We don't know what that 30 billion is. Some of it could have been stuff they already liquidated. Others of it could be stuff that is taken care of in another way. We don't know. But remember, unlike Credit Suisse, nothing was toxic that we know of at First Republic, nor does that match the history of First Republic, okay? Their issue was yield curve related, and that yield curve's impact on held to maturity. Okay, what did they take in on the liability side then? They took in 92.4 billion of the 104 billion deposits showing. So whether that 12 billion walked out the door between the end of March and this transaction or what, we don't know. Okay. Then in the blue box, you also get 28.1 billion of federal home loan advances. That's 2 billion more, by the way, than was on this balance sheet. And we're going to talk to that as well, because that means that the short-term, so you can kind of see that as like maybe the short-term borrowings were also FHLB advances. I don't think so, because usually they separate them out, but even so, it doesn't matter. The point is this number becomes 78. And then they got 50 billion in term financing. Again, we don't know the terms of that financing. I really wish they would have given it. They probably will to the analyst offline, possibly. But that 50 billion means that this 80 billion has a huge chunk out of it. 2.3 billion in other is probably these subnotes and liabilities. Okay. Some of it, it's unclear what exactly they were saying they are not taking. We know that they're not taking the preferred stuff on. So it's unclear to me what exactly this 2 billion is. Nonetheless, that number is lower than the 105 billion that you can see from the borrowing. So automatically, this thing becomes accretive for that reason, which is part of what I talked about in my call in the last episodes, which are linked in the show notes. And that's because of this. Remember, we talked about this in the last call. The reason, this is where the decline in return on capital came from, interest expense. Again, net interest income for a bank is revenue. And then the only other revenue is this other stuff down here. So interest income up here is net revenue. And then down here, non-interest income, that's fee-based revenue. That's what the other way to call that is. And so the only reason that their return on capital went from 12%, what it was the previous quarter, down to 6.6% was because of this right here, which is interest expense. That's the cost of capital. And so if he got rid of a huge chunk of this cost of capital because JP Morgan just had more cash on hand, he immediately made the return on capital go up again. And we see that in what he mouthed and said to us. Yeah, sorry. Thanks. I peed on Kenny's pool. I'm seeing some of that. Okay. So if he continues to be able to sell assets or otherwise liquidate and get rid of the totality of this borrow, the old return on capital for this book of loans was 12%, just FYI. Okay. And so he's clearly not buying it at 12%. So that's what, or, okay. So let's go back to it a bit. Yeah. And so that is what I'm seeing in the financials. Again, I want to remind you guys, because this came up in one of the Twitter spaces I was in, and two things that came up that I think may be misunderstood. First, some people said, well, First Republic stopped lending as soon as Silicon Valley Bank went under. That's not correct. Exactly. I'm going to say yes, kind of not really. And you can see that in the loan increases here. Now, these loans are going to not be held to maturity loans. That portion of the held to maturity loans will be in this up here, debt securities held to maturity. Here, that's not what that is. That's going to be younger loans. And then for context, you're going to need this, which is the rate increase of this rate increases over the last, period of time. Okay, so wherever it is on that spectrum is how we're thinking about it. Okay, let's see. And so these loans are going to be stuff that was lent more recently. Okay, so keep that kind of in mind as well. Let's see, other things that I just really want to show on this. This is what they said were the transaction assumptions. Okay, so 500 million net income accretion is what they are estimating. It's still an assumption. Everything has to kind of work itself. Yes, the deal is closed, and yet there's all this other stuff. So that's what I meant in my tweet, that this would be immediately accretive. Okay, and if people are like, oh, so the news reported it as small accretion. Jaimie Dimon, at least to his credit, was like, modest accretion. 500 million for the record, they'd make about $12 billion in net income. So you can kind of compare that per quarter. Okay. So you can kind of compare that. And this last quarter was a record quarter because, quite frankly, if you don't have bigger problems, you made out like a bandit, because that's what raising interest rate does. It increases net interest income, which for some reason is lost on a lot of people. It does this other thing to your duration risk, which I do in another video, such that about a 3-year year could, on a zero coupon, lose you around 8%, 8 and change percent. That's why this 12%. That's why this average loan mark of 87% of the value looks to me like it might be approximately a 4-year duration. So just realize, this whole mess is about raising interest rates really, really faster than the regional banks can actually go out and hedge it, or realize that they need to hedge aggressively. That's what this is all about. We lose sight of the dialogue easily, but that really is the issue. So it's accretive 500 million, but this one right here too also is getting missed. 2.6 billion in post-tax one-time gains, and they're saying you shouldn't be too aggressive on us because we're going to have about $2 billion in estimated restructuring costs. I would not, okay, look, estimate all you want, but I wouldn't be surprised if those costs came in low or high. And the reason I say that is because restructuring for a bank is firing people mostly and then selling assets at a discount. But you got these things at 87% of book. And by the way, these assets with their 0.06% credit loss rating are actually a higher credit situation. Like his book, by mixing in those loans with the existing loans, actually became less risky. Let me show you this. This was their loan losses. This is where their charge-offs were. Here are the charge-offs. This is like my little spreadsheet of keeping track. Hopefully you guys, there's a lot of mess on it, but what you're looking at is this column right here. I probably should have just cut and paste this out. Here's JP Morgan, 0.96 on charge-offs versus First Republic's charge-offs of 0.06. That just tells me that book of loans is higher quality. And so what you'll probably do is sell off your lower quality stuff. So when we're talking about, oh, I'm going to have $2 billion in restructuring, you know what I mean on that. That stuff, like, that's like just moving stuff around the table, that you're going to basically offload the other stuff that you probably would have offloaded anyway, but now you get a nice tax break on it. It's ridiculous. I'm just saying. Okay. CET ratio consistent with their Q4 targets was 13.5. That is actually historically high, but now that we all know that you need to be historically much higher, it's fine. You know what I mean? FDIC loss arrangements reduce risk. They're going to insure 80% of loans that barely ever default. It's a joke. And then average risk weighting of 25%, no change, right? Because these things weren't risky. All you needed was capital to manage the deposits from leaving the door. Now, some of the deposits will leave, some will just kind of calm down and stay put where they are until such a time as we really have full visibility in what's going on. So that's that. And then again, the average loan mark of 87%, they get to take that L against, they get to take that. I mean, like if it's more than you realize that these are paper losses. So if we continue to raise interest rates, therefore increasing or messing further with this duration issue, they get to take that against any gains. And are they having gains? Yeah, they're having gains. All the banks that aren't being attacked are having gains. Why are they having gains? Again, here, let me just show you one more time, because this is the new return on capital that all of them are doing if they can survive anywhere from 18%. Okay. Go into JP Morgan's balance sheet and look, they would have been at 17% as the highest, but he does a certain type of way that he manages his loan book. Wells Fargo, by the way, used to have like 10% ish, right? 10, 12, because they're still working through the unwind. And then PNC's never kissed 23% return on capital. That's ridiculous. So, this is not, oh, I'm not sharing my screen properly. Sorry. These are the return on capitals, right? 18, 14, 10, 23. That's other than JP Morgan, who manages its risk a certain way. Everybody else made out like a bandit on the quarter return on capital, because that's the nature of what happens. If you're not being attacked, your net interest margins increase. Sorry, is what it is. And if you're confused about that, you can take a look at SoFi's earnings, which I'll try to do a video on later. SoFi crushed it because the NIM was so high, and they've reserved against that in a particular way. So I think they'll be fine. The market's going to crush them regardless. But that's what happens when you have leverage to net interest income a certain way. It's just a joke. Yeah. Okay, let's see. There's a couple more slides and then I'll take some questions. These are other things that were in there. So here, I just want to remind people, JP Morgan wins, shareholders of banks lose, it looks like to me. And this, in theory, solves the banking crisis. This is the Fed and FDIC's chess move. That's why I put the little chess piece there. Does it or does it not? So Does it solve the crisis because we know JP Morgan's just going to take over the bank so the depositors have nothing to fear? Or does it cause a different set of problems because if you're a shareholder of a banking stock, you're going to this is not a great potential investment, because should they run into even the most baby problem and the stock starts to sell down, the speed of the bank run and the velocity of it is even faster. That's the real question we won't know the answer to. If we get a pause for a time, we won't know the answer until the next no pause. That's kind of how I'm thinking about it. The other thing that I would say related to this is just a reminder that between Bear Stearns and Lehman Brothers, there was actually a period of months. Okay, it wasn't so that's kind of that. And then the last thing that I would mention, okay, here's banks by deposit. The weakest players on the board, the chessboard, are Capital One and Citi, because I know you guys are going to ask me that. However, Citi's funding cost is done a little bit differently than your typical bank, because they do actually, because of the way they're really more consumer lending as much as they are a bank. And then Citi actually did really well in the quarter. It's just Citi has had a rough time of it for some time at this point. And then in the larger bank group, the other potential players to consider would be M&T Bank. Even though their numbers are fine, if someone was trying to take a run at the poll, this would be one to consider. And then the only other ones that I would think you may want to consider if you're like on the negative side of it would be Northern Trust and State Street. And then to a lesser extent, Bank of New York. But I'll tell you what, the Fed will protect Bank of New York with its life if it has to, just given where it sits in the spectrum of things. So those would be others that I would just now watch like a hawk. And other notes, JP Morgan now, I mean, they didn't state this, so somebody else will have to just state this and do the work for it, but I'm pretty sure this puts them over 10% of deposits at this point. Well over, let's call it. And then JP Morgan, just a reminder in case you're worried JP Morgan can't absorb this. Even though you can look at the balance sheet, look at the cash, they have lower held to maturity assets than deposits, that sort of thing. The real thing to note is that Jaimie don't play, so to speak. He had $488 billion worth of loss capacity. So this little baby $10 billion FDIC payment doesn't mean very much to him. And then finally, the last thing that I see as potentially a little bit funky is that out of all the things he said on the call, he was very clear that he wasn't going to do jumbo loans anymore. And that does have implications, not for the entire mortgage market. It really only has implications for that highest end of the mortgage market. Remembering that the types of loans that First Republic did were jumbo loans, but they did them at 40% loan to value for the most part. Let me see if I can find that slide just to prove that to you. This comes from their December filing. Yeah, here we go. So you can see it. Share that. So you can see the single family home size, 60% loan to value. Multifamily was done at 55% loan to value. And then any commercial real estate was done at 46%. Remembering that commercial real estate doesn't just mean office, by the way. For some reason, I think it's stuck in the journalist head that there's only one type of commercial real estate. That is ridiculous, okay? There's like many types of commercial real estate. Office and parts of retail are taking it on the chin. Other parts of retail are not. And they're not, because grocery stores are doing just fine, as are restaurants so far. Okay. So the other major types that are actually crushing it would be multifamily, which is shown separately. Residential is crushing it. Warehousing is doing just fine. And towers are kind of a mixed bag. And storage, like public storage, that sort of stuff, is also doing just fine. So those guys are all fine as far as that goes. That's what commercial real estate is. It's actually starting to make me a little bonkers that people just keep saying commercial real estate. What they mean is office real estate. But anyone that's a real talking head like Mr. Munger did not say it incorrectly. It's just that the press then requoted him incorrectly. So that's always a frustration point for me. Let me see what else. And then and then they are again not so. that is all I have prepared. Let me see if there are actually any questions. So are our local banks too risky to invest in now? I mean, it kind of, yeah. If I'm just being very direct and simple, there's probably a more complicated answer because each individual bank kind of has its own individual thing, quite frankly. But mostly speaking, if you see a bank run, then it's, however fast that you can get any of your uninsured deposits out quickly. Now, I will remind you that only certain banks have FDIC insurance. The credit unions primarily get private insurance, or they are insured in some other way. Every bank, though, by the way, puts on its website precisely its format of insurance. So if you've never done that double check for yourself, go do that double check for yourself. Some insurance, especially for overseas banks, caps out at 100,000. So remember that the FDIC insurance number is not the same as if you're not an FDIC insured bank. I definitely have thoughts on SoFi, so I'll come to this. Here's what my thoughts are on SoFi. But I still have to go through a couple more of their documents this morning. It was a busy morning. That looked like a crazy good quarter. His loss is actually lower than it has in the past. And remember, they are still in many ways in that middle part of their J curve. So they definitely benefited from taking in a bunch of deposits. They are giving a higher interest rates, but they're giving it, but the thing against it is, the loans that they're making more than compensate for it. So he's got this beautiful net interest margin. But because of the deposits he's taking in, this is the risk in the stock, right? He's taking in the deposits are against the loans is what allows him to be able to not have to sell those loans. If someone wanted to be a real jerk and then, let's call it, and then start figuring out some way for the depositors to depart in one fell swoop, he would have the same problem that First Republic had. He would just have loans that give you a higher yield. Okay, so the yield of the First Republic loans is fairly low because what they're doing is more conservative, and who they're doing it to is very conservative. I'm not saying that SoFi is not conservative in the way it issued loans. It's just that First Republic's user base is old money. SoFi's user base is young money. It's people with like a 730, I think he said, average credit rating, which means they're good, but they tend to be younger is the only difference between these two. So hopefully that clarifies. But Dave, I'll try to do a full episode on SoFi. This is pure contagion. Yeah. Hey, David, hope you're doing well. This is pure contagion. And it's not really contagion. Well, yes, I'm going to say yes, because that's how you meant it. And also, just to clarify what we mean by that, it's a bank run, right? That's what it is. That's why this deal is so accretive. And also, that's why if you were to compare the terms that he's getting, Jaimie Dimon is getting versus what Deutsche Bank got, it's like they went a little too far, in my opinion. So that's something to note. Let's see. What else do we have here? Okay, here's the thing. Corey, I'm not sure what the shares go to. And that's what's annoying about this. If they had done this the way that they had done it with Credit Suisse, which was they bought in the bank and then gave a price, then you would be able to argue between the debt and equity holders, right? He's buying the debt outright. There's nothing for the debt holders to argue at this point because their loans still exist. They've been transferred to another balance sheet. The equity holders, it's unclear what they get because of the nature of what's done. There is still the missing aspects that I told you, the deposits that are not the deposits. Well, the deposits probably are just deposits walked out the door, but like the loans that remain, what happened to that? That's the whole thing. And then since they're going to leave no franchise value because all of the First Republic banks will now become JP Morgan banks, there's no brand value remaining for the equity holder either. So likely yes, but it's very unclear. So like when MF Global went bust, this is the only one that I remember very clearly because I did have like some casino bets on it in my account. It took like a year and a half for them to work out who got what, and then finally close out the positions. So realize that. Hopefully that helps. I know that's not the best answer, Corey, but it's an answer. Let's see, 65 billion sold, not yet purchased stock. Oh, I know what you're talking about. So Kenny, you're talking about like the short interest. Yeah, this is going to be very interesting. This happened with Lehman, by the way, and it took a while for it to work itself out. I don't know the answer, to be fair. I wasn't short Lehman Brothers at the time, but if someone was short Lehman Brothers, they would know the answer to what this then entails. Because, and also, this is yet another reason why these rules on short selling. Look, I'm not. If you take away short selling from the marketplace, you create a very effed up marketplace. That one, it's not what I'm trying to say, but if you allow malicious or ridiculous, let's just call them use those two words, short selling, because you have this ridiculous rule that you never then do anything about, where market makers can have over the total shares outstanding by 5%, and you don't police it and you don't do anything further about it to force them to cover, then yeah, you end up with this ridiculousness. So I peed on Kenny's pool. Love your name, but that is correct. It is kind of messed up, but I don't know that that necessarily impacts Jaimie Dimon. Let's see what else we've got. I think that answers all the questions. Don't sweat it, Brandon. Just have enough capital on your account one way or the other, because it certainly isn't going to be high. I mean, stranger things have happened, but it doesn't look like you'll be in any kind of meaningful trouble. It's not like the thing's going to $10. Okay. Let's say it like that, or even 5. So yeah, it's always a little freaky when you can't close out your positions. That's true. I have some too, by the way. I'm right there with you, friend. But my stuff is all it's calendars, so I have the other leg of it one way or the other. Let's see. Okay, we're coming right up. All right. I'm not gonna make fun of Kramer because that man's worked really hard. I should be so lucky as to have his success. So I get it. Some of you guys are definitely not fans. Okay. And then just some shout outs. Savvy, hey to you and Scarlett. Really super appreciate you guys for stopping by and supporting me. Dave, how are you doing as well? Hope your trades are going well. And I think that's all the questions I'm seeing here. Feel free to put questions in the comments. I'll do the best I can to answer them. Technically, I'm having a little bit of a vacation in Sedona with my best friend. It's my annual girls trip. But hopefully I'll hike a little bit and then finally get back into shape. We shall see. Anyways, good luck on everybody's trades this week. We are not completely out of earnings season, so there's still volatility to come. Definitely give me a like, share, follow. Feel free to forward my videos too, because that always helps people find out about me. And then I have been posting a lot on Twitter, so if you guys enjoy these comments, you can find me there as well. It's just Markets with May.